Good morning, everybody. First of all, I want to say thank you for having me. I appreciate coming and talk to you. Usually it's hard for a CPA to get an audience because we talk about boring stuff, I guess, right? But, I was listening a little earlier and I heard 6 months, people being, I heard somebody say, I'm going to start my own business. I heard somebody say, I've been doing it for 6 months. I think I heard somebody say, I've been doing it for 10, right? Was it you right there? And no matter how far along you're on your business, it's always important to understand what's the best way to structure your business so that you can create the best taxes possible for yourself. Now, I'm not going to lie to you. If you're a successful business owner, you are going to pay taxes, okay? That's just a reality of it all. But the important thing to know is that you just got to pay what you're supposed to pay, not any less, not any more, correct? Less gets you in trouble. More is less wealth for you overall. So the important part is to understand the structures that are out there in order to create the best position for you. Now, everybody has different tax situations. So usually the best stories are the ones people come and tell me, well, my friend's CPA is doing this for them. And I said, yes, that's great. But I have no idea what their tax situation is overall. So I don't know if that's going to be a good tool for you. So everybody's situation is different, okay? I would say 95% will do the same, but there's that 5% that we have to plan out for your individual needs. Okay, so we're going to talk today about choice of business entity. I've heard LLCs, some people have corporations, some people have nothing, right? So we're going to go over those. I'm going to give you the pluses and minuses of each situation that you're in, and what can be done in order to create, a better situation for yourself. We're going to talk a little bit about the employee versus independent contractor, which I think is a big thing here, right? And it's actually a big thing everywhere. The state right now is cracking down on a lot of businesses regarding the whole relationship between an independent contractor and an employee. Okay, and I'll go through some of the pieces that you need to take into consideration in order for you to consider whether the person that's doing work for you, are they an employee or they're a subcontract. Okay? I'm going to talk a little bit about something that's kind of new. It came out in 2011. They started handing out 1099Ks. And I don't know how you guys deal with most of the people that hire you, but for a lot of businesses, if you get paid with a credit card, that's being reported now by MasterCard, Visa, American Express. They're going to report how much you actually got paid via credit card. And what's happening is we used to have what's called a 1099 miscellaneous, which people still hand out if you get paid more than $600 by somebody. What's going on right now is that there's going to be a lot of double counting happening. So it's very important to have a bookkeeper. It's very important to have some kind of track of how somebody paid you and how much they paid you, because if they paid you with a credit card and they send you a 1099 miscellaneous, you need to kick it back to them because it's going to double count your income. You don't want to pay taxes on income you didn't earn, right? We'll talk a little bit about meal entertainment and mileage, okay? Because those are mileage, you guys have a lot of it, right? You guys drive around a lot, so we'll talk about that. So let's start with the structure of your business. The ones that exist out there are sole proprietorships. That means I set up shop, I started working, doing my thing, right? That's straight up what a sole proprietorship is. Now, the problem with a sole proprietorship is there's a personal liability situation. That means that you're personally liable for anything that happens. So if you get sued, your personal assets are at stake. Plain and simple on that one. Okay? Then we have partnerships. I think you two ladies work together, right? So that's a partnership right there. We have two or more people that get together and decide we're going to do business together. That's a partnership, plain and simple. Okay?
We're actually an LLC.
What's that?
We're actually an LLC.
Yep, but it's a partnership. And we'll go over those. Then we have limited liability companies. Limited liability companies, they still call them new for some reason. I think they were around the 80s. But we like them because they're chameleons. For tax purposes, they're chameleons. So when people tell me I have an LLC, it doesn't tell me anything. Okay? Because an LLC could be a sole proprietorship. So if you're a sole ownership that opened up an LLC, that means you could be a sole proprietor. Okay? Or you can be an S Corp. Or you can be a C Corp. So you have choices, and that's why we call it a chameleon, because you have choices of what you want the LLC to be. And we'll go over some of those things, okay? The pluses on the LLC is that personal liability protection. Now, what people usually do, though, is the commingling of funds. They'll take the LLC money, and they'll go buy groceries at Safeway. So usually what happens is you've already pierced the corporate veil. You're commingling the funds of your company money, and you're buying personal things with it. So there's always got to be an extra step in between. You got to take the money out, put it in your bank account, then go to the grocery store, right? So usually a lot of people have LLCs, they think they're protected. I'll tell you right now that the first thing the lawyer looks at is, they look at the transactions between the bank and yourself, and they usually find a personal expense in there somewhere. So usually they can argue that you've pierced the corporate veil and that you have personal liability now. So be careful of that, okay? And I'm no lawyer, by the way, so I'm just letting you know. C Corporation. The C Corp has the best liability issues. Still the same situation, right? You got to keep it separate. You can't pierce that corporate veil. It has good benefits in some sense. The only bad thing it has is there's a double taxation issue that we have in there. And we'll talk about that a little bit. And then we have the S Corporation, which by far we believe is the best because it has the best of both worlds in there. So let's talk about the sole proprietor. Again, this is somebody that just set up shop, right? Decided, I'm going to start my own business. And, who was 6 months in? Was it you 6 months in, right? 10, okay. Did you just say, I'm going to start process serving all of a sudden? And bam, you went into it, right? And trust me, you're in a big majority of people that do that. I think this is by far the majority way that people do business when they just start off. They're just trying to put their toe in the pool, see what's going on. Can I make a go of this? It happens, okay? You don't have to file any legal filings with the state. If you want to have a doing business as, probably is the only thing that you have to do. You do a DBA. My name's Mary, and I work under Process Service USA, right? So that's my business name, right? That's all you have. Okay. So then we're talking about no legal protection, no limit liability. Let's say you were to hit somebody, on the way to serve somebody in your car. The business assets, your personal assets are at stake overall. Whether you were doing it, you can argue, well, I was doing business stuff. It doesn't matter. There's no distinction between, legally speaking, there's no distinction of what you're doing. Okay? Mary and Mary the server processor is still the same thing. There's no line in between to keep you safe in that sense. Again, like I said, that's the most common form of business. If I remember correctly, I think it's 70%. So it's a high number. Okay? No separate tax return is required, so you just file with your 1040. You file with your individual tax, a Schedule C on your taxes, okay? Now let me tell you what the risk of that is. The risk of Schedule C's is audit. The IRS has gotten in their head, and rightly so, that anybody who has a Schedule C is a tax cheat. They're using it as a loss to offset income so they can pay less taxes. That's what the rationalization is behind a Schedule C being a cheat. Now, it happens. The first couple of years, you're going to have losses. A couple of 3 years, you're going to have losses. Okay? The problem is if you have 3 years of losses consecutively, it gets you into a higher risk zone for audit because they think you're doing a hobby. The IRS says, this is a hobby. This is not a business. If this was a serious business, you'd be making money at it, not losing money at it, right? And trust me, they're not understanding it whatsoever. I had a client that had a couple of businesses. They were losing money. She actually took money out of her IRA, so she incurred a penalty. I think she took like 40 grand out and plugged it into this business and it lost money again, right? They didn't care. She got audited. They, hit her for it 3 years in a row. They said it's a hobby. They didn't allow her to take those losses, and she ended up with about a $20,000 tax bill. So they don't care. So usually we tell people, it's okay to have a Schedule C 1 year, 2 years. After that, you need to make a decision on what you want to do. If you want to make a go of this, then do something serious. Yes, sir?
Even if you're showing a profit those first 2 years?
If you're showing a profit, you're leaving a lot of money on the table, tax-wise. It depends on how much profit you're showing to. But, a profit on a Schedule C, you're looking at paying self-employment tax on the whole profit. And there's not a lot of planning that we can do with a Schedule C to save you money and create wealth for you. So, but yeah, once you start showing profit, it's best to move to something else. Okay? Let's see. So what I just mentioned, all net earnings are subject to self-employment tax and income tax. So let's say, gross income, you made 90 grand. When it's all said and done, after all your expenses, so you pay, going forward, it's going to be 15.3%. The last couple of years have been 13.3%, has been the self-employment tax. It's been lowered. But let's go with the 15.3% on $40,000. You pay the self-employment tax, you're stuck with that bill. You can never lower that amount. And then you have to pay income tax on top of it. Okay, so usually you're looking at easily 25 to 30% tax on that 40 grand. Automatic. No two ways about it. So you just left a lot of money on the table. And my experience has been people that have a Schedule C tend not to plan ahead on that money, and it hits them at the end. When I tell them that they owe, what's 30% of 4? It's 12 grand. It's not a pretty picture, because nobody saved the 12 grand. I'm pretty sure. I can tell you right now, nobody saved the 12 grand. And usually you don't need an EIN for one of these, unless you set up some kind of retirement plan. But it's not advisable. Usually people get an EIN anyways, just because. All right, let's move over to partnership. So partnerships are funny. So if you started a business with somebody and they're your partner, you're not automatically a partnership. Whether you didn't set up any structure, if you were 2 sole proprietors getting together doing this thing, you're automatically a partnership. Okay? So the IRS expects a partnership return to be done in that manner. So you can't be 2 people filing a Schedule C doing business together. Yeah, I guess you can get away with it, but it's not recommendable. Okay. Now again, you can have an LLC. You can set up an LLC and say, I want to be taxed as a partnership. Okay. Partnerships are good. It has flexibility, so you can change the ownership of the people's ownership year over year, and it's good because sometimes people say, you know what, I want all the losses this year because I'm going to make money somewhere else, investments or something like that. So I want the losses this year. Can I do that? With a partnership, you probably can. Right? Go ahead.
If you have 2 separate companies, that's not considered a partnership, is it?
2 different
If
LLCs.
they're under the same number, yeah.
Yeah, if it's 2 different deals, 2 different EIN numbers, it's not a partnership. It's more of a joint venture. So we're talking the flexibility of it. That's the biggest plus of a partnership, is how flexible it is in the way the partners are treated. How much you can give somebody in distributions, how much you can pass in gains, how much I can pass in loss. I just want to own the stock. I don't want any of the gains or losses. We can do all that stuff year over year. Okay? Now the biggest drag about the partnership is any income you earn on it gets self-employed taxes on it. So we're back at that. If I was a sole proprietor, I'm leaving a lot of money on the table. Okay? So you're set into that situation again, where if you're making pretty good money in a partnership, you're going to be paying self-employment tax on your personal taxes again. So it kind of isn't the greatest, okay? Now, we do multi-tier structures for some of our clients that are making good money and want to keep the partnership flexibility. Instead of them personally owning the shares of the partnership, we have an S corp own the shares, and I'll show you why that's important. Okay. Pass-through entity. That means that the partnership itself does not pay taxes. Okay. The income or losses get flowed through to the partners, and the partners themselves are responsible for the taxes. Okay. So there is no partnership tax. It's here's what we did, so it's more like an informational return to the IRS. Here's our income, here's our losses, okay? And this is what we passed over to the partners, and then the partners deal with themselves, okay? Tax returns are due a month earlier. Is that correct? No. Partnerships are due April 15. If you get an extension, it's due a month before than it was before. Okay, so it's going to be September 15, because you have to send in the information to the partners so they can file their taxes by 10/15, correct? Usually partnerships are used for real estate investments. They have way better tax positions for real estate investments. If you sell and buy real estate, an LLC or a partnership is the best way to go. Do not put any real estate property in a corporation, because you're going to pay a lot of tax when you get it out. Okay? If you ever pick anything out of here, that's one of them. All right. So the limited liability company, like we talked about, right? It's a bit of a chameleon. So what you do is you go to the state, Secretary of State, and you say, I want to be, I'm going to pick on Mary again. I don't even know there's a Mary in here. We'll call it, Process Server USA, comma, LLC. So that's me now, okay? So I've created a different entity. And what I do after that is I go get an EIN number for Process Server USA, LLC. And I tell the IRS, at that moment in time, I have a choice. How do I want to be taxed at this moment? And you have three choices. You can be a sole proprietor, you can be an S corp, or you can be a C corporation as an LLC. Okay? So you have a choice of what you want to do. Once you have the EIN number, you can open a bank account with it. So now Process Servers USA LLC has its own bank account. It's its own little deal. Right? And that's where I run all my income through. That's where I run all my expenses through. And that's how we keep it. If there's two people in the LLC, then it's a partnership, right? Automatic partnership. But then you still have that choice, how you want to be taxed. Okay? Again, the biggest thing of an LLC, guys, is keep it separate. Keep the funds separate. It's very important to keep those funds separate. If you need money, just distribute it to yourself. Write a check to yourself out. Right? Process Server USA writes a check to Mary as an owner, and you go put it in your bank account and then spend it as you will. Remember, you got to pay taxes on it. Yes?
And with this electronic age, is it the same thing if you just go in and transfer them?
Yep, same thing.
Okay.
Yeah.
I didn't read the hard copy.
I know. I'm just trying to create a visual. I'm trying to create a visual. There's a step in between that you have to do. Don't go buy something personal right off the bank account, because it creates problems. Okay. So did we get that LLC right? So if you tell me you're an LLC, I have no clue. I have no clue what you are. My best guess is you're a sole proprietor. Okay? If you never made an election to otherwise, that's my best guess. And if there's two of you, I'm assuming you're a partnership. All right. So let's talk a little bit about a C Corp. Now the C Corp was created a long time ago, and what it did is it created that liability separation, right? If something happened in the course of business during the C Corp, it stays within the C Corp, right? Only the assets of the corporation are at stake. The IRS looks at it as a different person. It's a different entity. It's a person, Okay? So therefore, it pays its own taxes. So once you figure out, I made 90 grand gross, I came out at the bottom with $40,000 of earnings, the IRS has brackets for a C Corp. Less than 25, you pay 15%, over you pay 30. So you're there. The thing is, the corporation pays its own taxes. If you distribute yourself money, you pay 15% tax on that. So you're automatically double taxed for your own money. So that's why C corporations are not recommended for small business owners. Now, if you have a lot of health problems, health issues, a C Corp is the way to go. Because the C Corp has tremendous fringe benefits that we can provide to you. We have a client that spends about 40 grand a year in medical expenses. And we have them in a C corporation because of the certain fact that it's more beneficial for us to expense that through his corporation than to have him at the personal level. So there are, again, right? There are those individual pieces that we have to take into consideration when we're setting up your structure. So it's good to sit down with the CPA and go over not just your business life, but what does your personal life look like also, so that we can plan it correctly for you. Because if that guy would just come up to me and said, I have a C Corp, I would laugh and say, somebody's messing you up. But I don't know his personal situation, right? Because automatically for me, an S Corp is the way to go. And a C Corp is not the greatest situation because you have a double taxation issue. But for that guy, it works out really well. And we can make it work well to where it's more tax advantageous for him. So it goes back to that, right? You have to show the full picture in order for me to understand your tax ramifications of everything we do. So then we have the S Corporation, which is our favorite. Okay? S Corporation acts as a partnership because things flow through to it, and it acts as a corporation because we have certain rights in there. Okay? Now, the thing is, because it's too good to be true, there are some limitations of what you can do. The corporation, if you are a 50-50 owner, you will always have 50% distributions. So you have to, if you distribute $1,000 to one of the partners, you have to distribute $1,000 to the other. You can't take, different amounts, never. If you have 50% losses, the other guy needs 50% losses. Okay, it's very rigid in that sense. It's, whatever your amount of stock holding is, that's how much you get of everything. Okay. Now the beautiful thing about an S Corp is that it's a flow-through item. So the corporation doesn't pay taxes. Okay. The partners are the ones that, or the owner, because you can have one owner in an S Corp. The owner is the one that, reports the income. The other thing that's important in an S Corp is you have to have what's considered reasonable salary. That's what it's called, reasonable salary. Okay? People have abused it a lot. I've seen people that make $200,000 and they pay themselves $1. I mean, if you laugh at it, it's obviously not reasonable, right? So, there has to be a laugh test in there somewhere on that situation. If it makes you grin and smirk about how much somebody's paying themselves because how much they're making, it's probably not enough, right? So, usually what we do with our clients is we split 50-50 depending on how much it is, right? We do a 50-50 split. The true test is, can you live on the amount that you've pulled down as wages? That is the true test of it all. And that's one of the things the IRS will always look like if you're getting audited as an S Corp. Is the amount that you paid yourself enough for you to crack your nut, if you will, right? Because you can take distributions from the corporation and the only tax you pay on those is income tax. There's no self-employment tax on that, okay? Because when you draw a wage, right, a reasonable wage, you're a W-2 employee of your corporation and you have to pay virtually the self-employment tax. You got to pay the employee side and the employer side. It just happens you're the both, right? your employee and the employer. So you end up paying wages on that. So the savings that come from being an S corp is, we go back to that same scenario of, you made 90 gross, and at the end of the day, I ended up with 40 net income. In a Schedule C, that 40 gets taxed at 15.3% overall, right? That's our self-employment tax. In an S corp, what you're looking at is, we're going to split it in half. 20,000 you'll pay self-employment tax on. The other 20, you only pay net income tax on, just income tax on it. So automatically, I just save 50% on taxes, right? Just like that, 50% on taxes. And there's other things that we can do. Health insurance, we can gross up your wages for that. So, and you don't pay self-income tax on that. So now we just lowered how much money you're paying on taxes. Yes, sir?
Do you do a health insurance under an LLC? Reimburse for health insurance premiums?
The HRA situations? Or,
Not an HRA.
no.
Just got that.
So are you filing on a Schedule C, I'm assuming, or?
A1.
So you're a partnership or an S corp?
Partnership.
A partnership? So in a partnership, health insurance is not deductible. You have to put on the K1 as information. It's a distribution to you.
How hard is it to change if you're already set up that way to
Not very.
an S corp?
Not very hard. Yeah. Usually the deadline for that is March 15th of the year that you want to be regarded as an S corp. So if you wanted to be an S corp for 2012, you had to do that in March 15th. Now there's ways around that. The IRS, Congress has dictated to the IRS that they should make it pretty simple for somebody to become an S corp. Unless something gross negligence happened, it's hard for you to become an S corp late. But we can always come up with a reason why you missed the deadline. And we've had pretty good success at turning somebody that filed late for an S corp into an S corp. So it's not that hard. You just got to file a form. I think I have it on there. Yep, 2553. Just file the form 2553. Yes, sir.
Do you have to have officers to be an S corp?
Yes. So if you're a solo man show, you're the president. You're it. You're the officer.
So you don't have to have a vice president and a secretary?
Nah.
They used to, right, when they first started.
Now here's the thing, because you can set up your company as a corporation at the state level, and that's a different deal, right? As a corporation instead of an LLC. Now you're talking about legalities here. As a corporation, you're supposed to have an annual board meeting, even if it's with yourself and your accountant or your lawyer, right? You're supposed to keep minutes and all this stuff that you have to go through, the hoopla. As an LLC, you have a little more flexibility in that. You don't have to do all that stuff. So that's why we recommend the LLC, because you don't. LLC taxes an S corp. Yep. We still make that choice, right? We have the election choice. In a corporation, all you have choices of is an S corp or a corporation, a C corp. That's all you have choices of. So I know that's a little confusing. Okay, some of the other restrictions that we have is yes, ma'am.
I'm so sorry.
No, you're okay.
The next topic.
No, I'm not. We're still in this one.
Okay, it's not clicking so far. I mean, it is in a sense, but I think for myself, probably gonna hold off just a little longer.
You just started, right?
Yeah.
Yeah, I would recommend just setting up an LLC for liability purposes, for protection, and give a go at it for first year. Do a Schedule C on it. It's okay.
Okay, so is there any way that, that, I don't know, maybe for myself, I can schedule something with you to go over all that maybe?
Yes, we can do that. We can talk afterwards. That's fine. Okay, so an S corporation. So an S corporation, the limitations is you have 100 shareholders, which I hope anybody here in the room doesn't grow to be more than 100 people in their business. I hope not. That's just too big, right? 100 bosses in one place, never good. The other one is, you can't have anybody that's a non-resident alien, so an illegal person, if you will. You can't have any other entities as being owners of the company. So it has to be an individual overall. Okay? That's why we talked about the partnership being good, because a partnership can have not illegal, I want to say foreign individuals. We just have a client that came in. His partner is this guy from Iraq. They're doing oil and gas stuff. So it's okay. So they automatically have to be a partnership. We can't move them to an S corp. Okay. Let's see, what's the other one? So that thing that I was telling there, that says provide savings in Social Security and Medicare taxes. That's what I was talking about. That split of that net income amount, because we can save on 50% of that income, that self-employment tax. We remove that from the equation. You only pay income tax on it. So automatically, that creates a savings for you right there. And a good threshold, I would say, is when you start making, in a Schedule C, when you start making around the $40,000, $50,000 mark, it's when it's a good time to start thinking about an S corp. Okay? I'm not talking about net income, not gross. Okay? Net income, after all your expenses are removed, a good mark is around that 40, 50. It's when you start considering the S corp, because that's when you start reaping a lot of the benefits for it. Okay? See, any other questions about the S corp? This is the one I like the most, so ask me anything you want. Okay, so let's go into the 1099 employer issue. I'm going to tell you a true story, okay? I have a client, they had 19 independent contractors. And then they started looking at the work that we're getting. This is an IT company, by the way. And the people they had as subcontracts just, they didn't have the skills that they needed in order for them to actually do the job that was required. So they said, we're going to have to go somewhere else to find people. So they let go. They pretty much canceled the contracts with the subcontractors they had, and they outsourced it. Okay. One of the subcontracts decided that he was going to go file for unemployment. That's all it takes. That's all it takes. It's for one person to go file unemployment. So the state came to them and said, somebody filed unemployment. We need to verify that they're an employee. It looks like you never withheld any wages, right? It looks like you never withheld any taxes. You didn't have any state unemployment tax. You didn't pay any federal unemployment tax on this stuff. So then they start sniffing around, okay? And they had a contract with the guy. He signed it saying, I'm a subcontractor for this company. I will be paid with a 1099 miscellaneous, all the hoopla. And the state still said, nope, sorry, you're going to have to pay unemployment for this person. So that's how tough that situation is. So you can cover your behind as much as you can with paperwork and signatures and stuff. The state would always advocate for the employee or for the person that you're subcontracting. Okay? So it's always best to err on the side of this is an employee than to err on the side of this is a subcontract. Especially right now, the last few years, they've been going hard at it because the state has no money, right? They're broke. They're looking for income anywhere they can get it. And this is one of the things they picked on, because a lot of small business owners, the way that they save money is, I'm going to just hire somebody as a subcontract, right? Because I don't have to pay taxes, I don't have to do a lot of forms to get all this stuff going. That's the mentality that we go with, okay? I'm not saying it's wrong. What I'm saying is that people don't think it all the way through. So let's talk a little bit about some of this stuff. We talk about when somebody's considered an employer, an employee, you have to do you have to do all the taxes, the withholdings that you have to do. You have to give them a W-2, file all the taxes that you have to file on a quarterly basis. So it creates cost, right? Not only just the taxes, but you have to pay somebody to file the forms for you. So let's talk about control. That's one of the biggest pieces they look at. What is the control? If you have an individual that you subcontract, but you tell them, I need you to be here from 8 to 5, every day, right? You're exerting control on that person, correct? So automatically right there, that tells you that more likely than not, that's an employee. Because a subcontract, the way the subcontractor works is, here's this project, I need it by Wednesday. You don't care if the subcontract does it at 2 in the morning or after he's been out at the bars at night. You don't care. What you want is the project on your desk by Wednesday morning, right? So that shows no control. You're just giving them a deadline. I need this done by then. And that's all there is to it. You don't care if he shows up at 9 o'clock. You don't care if he comes in at 10. You just want the project done, okay? So there's that thin line, control. The other part is training. If you say, what's your name? Sorry.
John.
If you say, John, welcome to Process Server USA. So this is how we do things here, John. First, we come in the morning. It's 9 in the morning, and we do X, and then we do Y, and then we do Z, and I expect you to do X, Y, and Z for me while you're here. Right? So you've just trained John on how to do his job. So automatically, you could argue that John's your employee. Because John likes to do it Y, X, and Z. As an independent contractor, that's what you hired him for, to do a project, right? And you don't care how he does it. You just want it done. So there's that distinction, right? Yes?
I got a question.
I know, it's-
So, so all of us, we have a certain format. We need the date and time, who was served and when they were served, and that needs to be put down so we can fill out the affidavit.
Correct.
How is that controlled if that's?
That's not, but that's just a rule of your business, right? That's just a regulation of how things need to be done in your business,
Okay.
right? That's different. That's a little bit different because that's a regulation of how things need to be done overall. So that's the same everywhere for everybody,
Yeah.
right?
How is that not telling them, how is
Because
that not
that's-
training?
No, but if you hire somebody that's going to be a server processor,
Yeah.
hopefully they have enough experience to understand that piece. So that's not training, okay? Training is a different piece. It's how you operate as a business. So what makes you as a business individual? Does that make sense? So let's say like the person that answers the phone for the front desk, right? He might want it to be, hello, you've reached Process Servers, how may I help you? You may have it as, good morning, this is Process Servers, how can I help you? And somebody else may have it as, hello, it's different, right? So that's where that training comes, the individual parts of your business. That's training because you're training somebody. This is how I want you to answer the phone.
So you're speaking more along the lines of office staffing, not
Kinda, yes.
process server.
But you understand what I'm saying though?
Yes.
You're telling them how to do their job, in a sense. Because this is the way you like it done. It doesn't matter how everybody else likes it done. This is how you like it done. But what you were just talking about, it sounds like everybody needs to do that, right?
Well, I'm pretty sure all of us have, at some point or another, had to tell our servers, you have to knock on the door. Don't knock on the door past 10. You cannot say XYZ when you're talking to the client. We've all gotten instructions from
Correct.
various clients on what they want. And so we pass that training.
And that's
I would
fine.
say, on our
But it's
people.
we'll talk a little more about that.
Excuse me.
Yeah.
I think we're going to have an attorney come in and talk to the association
Okay.
that does different than him and probably could go into more depth because that's not controlled. Where we're talking about really, let's just kind of leave it at that so he can finish his deal.
Yeah.
But we're going to have an attorney come in and talk to us because they talk to us different
Training,
than
ratio.
the CPA does.
Okay, so one of the other ones I've seen are plumbers and stuff. Let me just go over this little piece a little bit. Like plumbers, construction guys, they'll give their guys a shirt with their business logo on it and stuff, especially like a salesperson, right? And they represent, they're from that company, okay? That kind of clicks a little button on somebody and saying, that might be an employee because he's representing himself or themselves as, I work for this company, right? So that's one of the biggest pieces too on that. Let me answer this gentleman's question first. Yes, sir.
Okay, if your process server comes to you as an independent contractor carrying
documents such as his own corporation documents.
Yep.
Or his own insurance liability.
Yep.
Then at that point, he constitutes an independent contractor, right?
You have a better chance.
Better chance, what makes it?
So the other piece that's a good question, because the other piece I was going to go over is make sure that this person does this for somebody else too. That automatically gives you a lot of standing ground when it comes to fighting the fight of they're an independent contractor. Because they're doing this for somebody else, not just you, right? So now they've spread themselves around, so they have their own little business. You're one of their customers. And they have other customers that they do process serving for also. And they have their own insurance, they have their own LLC. So those are the things that are important to kind of, have in place when you're looking at an independent contractor. Make sure that they do it for somebody else. Make sure that they don't work for you 40 hours and only you, and you're the only client, because that just puts you into that position that this person might be an employee. Sir?
Most software programs used by process servers have a thing called a trip sheet, and that gives instructions to the person receiving the papers to serve, telling them how to serve them, personal service, sub-serve, where to go, what the address is, and also when the papers must be served by, and so on. Is that a prima facie example of giving instruction?
Not necessarily, because that's just a system that you have, and it sounds like it's common around everybody's. So there's no individual piece there. The other piece is, do they have the ability to create a profit for themselves? Okay. Let's talk a little bit about the car salesman guy, right? He has incentives to sell a car because he's going to make a profit, a commission of some type or another, right? But if you just say, John, you're going to work for me. You're just going to sell cars. I need 5 cars sold this month. I don't know if that's a good quota. I need 5 cars sold this month. If John has no incentive whatsoever to sell 5 cars and he's still going to get a paycheck out of it, he's an employee, right? But if you give him the motivation that, they can make some kind of commission off of it, that somehow they're going to end up with some kind of net income, some kind of profit out of all this for their troubles, then that kind of helps your situation too, on how you stand on that. Relationship, that's what I was telling you about. You show up with the shirt with the logo, that automatically throws you in trouble. Let's see. We talked about this a little bit already. The most important thing right now is if your business starts growing to the point where you're paying out enough money to people, just make sure that you have a bookkeeper. It's really important to do so. Especially now, it's just getting worse, especially with all the 1099s that they're requiring, and you're in the business of serving people, not doing books. It deters from the growth of your business. It keeps you from actually being successful. Because if you're spending 5 hours doing your books, that's 5 hours you could be doing something else. Or even at least spending with your family, for God's sakes. Right? So consider that. Do what you do best. Don't do somebody else's job. Meals and entertainment, pretty easy. The receipt has 3 of the 5 things that you require. It already has a date, the amount that you pay for it, and the place that you ate. But what it doesn't have is who you met with, and who you met with, and what was the business that you guys talked about. So what's important when you have a business lunch, or dinner, or breakfast, whatever you want to call it, right at the back of the receipt, right, I met with John, and we talked about, working together on a deal, right? And that helps you, and that gives you backup for your meal and entertainment expense. This is one of the most abused ones too. I had a guy ask me, he goes, can I just take my wife out to dinner and put it as a meal and entertainment expense? No. What kind of business were you talking about? Nothing good, right? If it's over $75, keep the receipt, okay? Now, I'm going to tell you this. Those thermal receipts, after 2 years, they're done. You can't read anything on them. So scan them, okay? Scan them because the IRS shows up 3 years after the fact, for the most part. And then you're going to show them this thing and it's blank, right? It looks like a blank piece of paper on it. And it's not going to fly. So scan them, keep some kind of electronic copy for it. That's why, having books is also important, because you can show them all this information. I think that's all I got. Yes, sir.
What is the no receipt required?
If it's less than $75.
Oh, if it's less.
Yeah, if it's less than $75, you don't need to have a receipt. You don't have to show the receipt for it. But we tell our clients to just keep them anyways, because it's just better that way. Because then you're not lying. I think the other thing was mileage. And mileage varies from year to year. We have, I think this year it's 55.5 cents per mile that you have the option to write off as part of your business. And depending on what structure you are, there's little different treatments to it. But overall, it's beneficial. I've seen situations where, because you could take actual cost too. And if you have older vehicles, usually actual cost comes close or goes over. But for the most part, mileage always does it. So it's good to keep track of your miles that you have. You have to have a log, because again, this is one of the most abused. From you guys, I would expect, I drove 15,000 miles this year for business. I would expect that. But I've had, people that have an office and they're, lawyers or professionals tell me that they drove, 12,000 miles for business. It doesn't fly. I tell them, no way. No way you drove 12,000 miles. But, it depends on the industry. And you guys are pretty mile heavy. So I would keep a lot of track of it, to make sure that if you ever were to get audited, you have that log and you say, here you go. And it keeps them away that way. So any other questions? I mean, that's pretty much all I have. Yes?
Regarding the mileage, is there much of a difference of how you claim that between a sole proprietorship and actually having the S Corp or the LLC?
For an S Corp, we tell our clients to reimburse themselves for the mileage themselves. So the corporation takes on the expense. So it will be the same. As a Schedule C, just keep track, and at the end of the year, you give the mileage to whoever's preparing your taxes, and you'll get the deduction right there. So, yeah.
One last question.
On the mileage, when I worked for a home building company, people couldn't deduct the miles going to work.
Correct.
If they drove around the construction site, they could.
Yes.
So if I'm delivering a paper, and I'm just going there and coming right back, do I just kind of deduct going and coming, or just?
So commuting is not a deductible thing. So if you have a home office, what we tell people is go get a P.O. box nearby your house, because to travel to check the mail, it's the commuting mileage. Anything after that is deductible.
I'm not sure that, I know that answers my question. Not
Okay. No, so what you said was going to work doesn't count. But anything after that, count it.
If I live in Denver and I go to a ward to serve a paper and then come back home, I can't deduct any miles?
Where's your office?
Denver.
In home? Yeah, you're fine then. Because you just did business in Aurora, right? You drove all the way to serve a paper in Aurora. Come back, that's deductible.
Both ways.
Yes, both ways.
You have to deduct, going to work mileage because you're working at home.
Yeah.
So if you had a PO box, I don't know, but I wouldn't even worry about it.
But if you have a regular office, right? Like let's say next door, right? And your house is in Denver, the mileage to come from your house to your office is not deductible. It's considered commuting, right? That's considered commuting. That's a commute. So usually what we tell people is get a P.O. box somewhere close to your house, especially if you have a long commute. Stop by the P.O. box first, right? Because any mileage after that is deductible. So maybe you just made your commute 2 miles instead of 30. Yeah? Little tricks.
Thank you very much, Victor.
Yeah, no problem.